Good morning and welcome to the Literacy Capital PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Paul Pinder, Chairman. Good morning to you, sir.
Thank you very much indeed, Alessandro. Good morning, everybody, and thank you very much indeed for taking the time to listen to us today. We appreciate it. We will give you hopefully a reasonably brief introduction to Literacy Capital and what we are seeking to achieve, and then, as Alessandro said, we'd be very happy to take your questions. Just by way of introduction, I'm Paul Pinder. In my previous career before Literacy Capital, I was the CEO of CAPITAL. During my 25-year tenure with the company, we actually generated a total shareholder return of 480 times shareholders' money. But I guess probably the more relevant element to it was the fact that we built a lot of experience of buying and growing private companies. So during my tenure, we acquired in excess of 200 private businesses, and I think learned quite a lot about building value, which hopefully will prove also to be relevant with Literacy Capital. I'm just going to hand over to Rich, who will introduce himself as well.
Hi, good morning. Richard Pinder, CEO of the investment manager and director of the fund. Similar to Paul, have been involved in Literacy Capital since it was set up in September 2017. And then before that was also working within private equity, so have been involved in investing in and supporting smaller businesses now for in excess of the last 10 years. Look forward to giving you some familiar background on the fund, but also giving you a bit of an update on what we've been up to in the last few months and an outlook for 2025.
So we're conscious that some of our listeners today will be very familiar with what we do, but also some will be newer. So just kind of by way of a brief overview, we really set ourselves up with the objective that we wanted to try and help build some great UK smaller businesses. We are looking to acquire privately owned businesses, and Richard shortly will talk to you more about the kind of things that we're kind of looking for. I guess for many of you guys who invest in the investment trust sector in general, one of the advantages that we have over the listed arena is we have the ability to get very heavily involved and be very influential with the companies. And that spans a whole range of things in terms of including being involved with M&A, but also helping to select and build management teams as well. So we're allowed or we're able to be very engaged and very influential. We also set ourselves up to differentiate ourselves materially from other private equity style organisations. And again, we'll have a slide for you a little later just to talk about those main differences. But from an investor perspective, I think when Rich and I set this up, we felt that private equity executives were not always brilliantly aligned with the people that invested, both with respect to motivations to sell businesses prematurely and also the financial incentives whereby the executives took quite a material share of any gains. And so the advantage that we have as Literacy Capital, one is the investment trust structure means that we're a permanent capital fund. It means that we can take a very patient view of investing in businesses, and we don't have a predetermined window for how long we're invested in those companies. And secondly, we quite deliberately have not paid any form of carried interest or performance fees either to ourselves or to the management team, because again, we think that skews behaviour. And indeed, if you look at the alignment that we do have, Rich and I, you can see on your screens today, we collectively own roughly 40% of the fund ourselves, which again, within the investment trust sector is pretty unusual, but it's also within the private equity arena is very unusual. And so our main motivation is to drive the share price up northerly over a long period of time, which again, we think hopefully makes our objectives pretty well aligned with shareholders. We run a reasonably concentrated portfolio of companies. So as of today, we have 21 businesses in the portfolio. We have a slide later on that will talk about the most material ones. And again, we're more than happy to take questions on any of those businesses. And as I've mentioned, we're also very happy to be very actively engaged with those businesses and get involved, both in terms of helping them be stronger and better, and equally, if there are problems or challenges, we're also happy to try and get involved and see if we can help square those away. The last element that I was just going to touch on in the overview, which makes us genuinely unique, is when we set Literacy Capital up 7 years ago, we didn't want our objective to be solely about making money for ourselves and shareholders, but we wanted to do some greater good than that. So for those of you who've ever visited us in our offices, you'll see that the investment team also share the same floor with the charity team. And the charitable objective is to try and help young children, disadvantaged children, learn to read, because the UK has got a pretty significant problem with literacy, where a quarter of children leave school at the age of 11 unable to read to a reasonable standard. And so we each year give away a portion of the fund, 0.5%, into literacy charities, where the primary beneficiary is bookmark reading and helping that objective. And so you'll see from the slide thus far, we've actually donated 11.6 million, but probably more relevantly, we've helped many thousand children across the UK hopefully achieve a better outcome in their later life by virtue of the help that we've given them.
So I'm just going to give you a few minutes on the types of investments that we seek to make and into what types of businesses and situations. So we look at, I mean, if you've seen our portfolio, it's very varied in terms of activities that the businesses have. Sectors across the board can be house building, can be business services, healthcare, a complete myriad of different sectors. I guess the common thing that they would have familiar across many of them is relatively healthy margins and cash generation. So, every quarter we report what our profit margins are as a kind of collective across all of them or across the top 10. So that is in excess of 20%. We are very illiberal with our use of leverage. So we're deliberately conservative at the outset of our investments. They're relatively small businesses when we invest in them, and they might have a degree of customer concentration or reliance on a small number of individuals within those businesses. And so we want those businesses to have the freedom to be able to invest, to grow, rather than being kind of tightly managed to covenants. So ordinarily on day one, we might use no leverage. We might use 1.5 times of EBITDA as kind of maximum gross leverage at the outset. We're very flexible about having minority or majority holdings. So many of our recent investments, we've actually been a kind of significant minority shareholder rather than taking a majority stake, which is reasonably unusual, or certainly less common amongst private equity investors. I guess an important attraction of what literacy is able to offer is reliability and speed. The first bullet point there in the second segment, we've got a 100% track record of delivering on the terms that we put forward to vendors. And again, the types of investments that we're making are completely different to the listed universe that Paul touched on. We are typically having to transact with shareholders of businesses where there might be one individual, or certainly a small number of individuals. You can count them on one hand. And so for them to have the trust and believe that what we put forward is deliverable is pretty key to them. Again, given all of the businesses we've invested in, they've never had external shareholders before. So, going through that process of selling a business for the first time, it's not something they've ever encountered. It's not something they're often particularly comfortable or confident in doing. Part of that, again, is around speed. So, we've done deals before from first meetings to completion in 6 weeks, which is very, very unusual, particularly for businesses that in several cases are not particularly well set up to go through a transaction. The information they have, or potentially the advisors they have, they've not been through loads of transactions before. As we've kind of touched on, we're quite fluid and flexible as to the types of investments that we can look at. We're quite willing to take on board the preferences of the founders or the existing shareholders of those businesses to work out what it is that's most important to them, and how we can accommodate those needs. And I guess another important value add is it's not just the businesses that we're seeking to invest in and leave them to crack on, you know, in the same fashion or manner that they've been running themselves in the past. Another important question we ask ourselves is, often these businesses will need additional experience and expertise to help take them from relatively small businesses reliant on a small number of individuals to something much more well established and much, much larger. So, you know, this final segment of bullet points on this page here touches on the additional resource that we're often able to provide to businesses. And we'll give a couple of examples later on in this presentation as to how we've done that in recent investments. But again, we can't just leave our businesses to sort of run themselves. And often there does need to be an element of change, because often the reason for these businesses being available to invest in, typically or often it's retirement, or often it's the founders of the business realizing that there needs to be an element of change within the way things are done or within the management team in order to maximize the business's potential. And we'll give some specific examples shortly.
So just to provide a little bit more colour on what makes us different from what we would believe is traditional PE. I mean, it's interesting, if you look at the listed market, there's probably something like 15 or 20 listed private equity trusts. I know a lot of people believe they're unique, but I think we are unique amongst all of those trusts for a whole variety of reasons. So I won't go through this in huge detail, but just as a canter, Rich has already identified the fact that we are looking for predominantly smaller businesses. We do that for a range of reasons. One, because we think the upside is significantly greater, but also it's a segment of the market which is very underserved. If you're a PE house, you tend to look at bigger and bigger deals because you want bigger funds under management, because you can charge larger fees. We're much more motivated by actually making a return on our investment. And it's the least competitive area of the market, which means by definition that we can then get our entry price on acquisition of these businesses to be materially cheaper. Richard's alluded to the debt structure. We want management teams that are focused on growing the business rather than worried about whether they can meet covenants. So again, some of the private equity or the bigger private equity funds are very comfortable with leverage levels of 5, 7, 9 times EBITDA. We're not comfortable with that, and we kind of don't do it. We've talked about alignment of interest with investors, but we also structure our deals so there's high alignment of interest with our management teams. We view our management teams as friends and colleagues, and we want them to be successful, and we want them to make money alongside us. And so we structure the deals in that way. I've talked about the fact that we charge uniquely no performance fees whatsoever, which is virtually unheard of within the private equity world. We do focus a lot on adding value. So Richard alluded in the previous slide to the number of executives that we've added to our teams. And if I'm frank with you, we have been blessed by the caliber and the quality of people that we have been able to attract into literacy companies. In many instances, we've attracted managers that are on a CV basis wildly overqualified to do the jobs that we're asking them to do. But the reality is, they enjoy the environment, and we also give them good incentives for doing it. And lastly, we try to be very non-bureaucratic. So Rich has again given examples of where we will get deals done quickly, not to be irresponsible, but just to not get involved in pointless processes, because it's the way things are always done. We do the things which we believe will add the most value, but equally we are able to transact in a pretty swift manner, which for the companies that we're talking to is a pretty attractive feature.
Just touch on some kind of recent activity, so sort of more in the last 3 months or the last few years. So you can see that net assets in the most recent quarter, for which the results were published yesterday morning, net assets per share were up 3.8%. This followed a period in 2024 where we saw net assets actually decline very, very slightly to just over 1%. Which is obviously slightly disappointing, but probably not too surprising given the macroeconomic conditions that we saw and sort of relatively weak growth across the UK. Longer term, and again, you know, looking at performance over a single year is probably not hugely instructive, and certainly not what we'd encourage shareholders to do. But much longer term, the performance is very, very strong. And I guess also we've looked at just to sort of break out constituent parts to that, we have highlighted Grace and TechPoint, two portfolio companies that have found the going slightly tougher in 24 and 23. We've done some analysis to exclude the impact of their performance since the inception of the fund. And I guess if you look at the performance of the fund as a whole, we've had some very, very strong periods of performance. But actually, those two portfolio companies helped to contribute to that, and they saw extremely strong trading sort of early on, kind of impact of COVID, which helped to sort of almost double the performance of the fund in 2020, kind of before excluding those two portfolio companies. And similarly in 2021, when market conditions were very, very strong, they helped to contribute nearly a doubling of NAV in 21. And similarly in 22, their performance was strongly positive. Both of those have seen performance be more muted in 23 and 24. But if you strip out the impact of those two portfolio companies, for the last 5 years, NAV growth has kind of been in double-digit positive territory. And I would expect neither of those portfolio companies in 2025 to contribute a negative performance. So I think we're out of the worst of the periods of performance for both of those two companies. I guess what we've been up to in the first few months of this year, we've been refinancing strongly performing portfolio companies of ours. Effectively, what that means is effectively remortgaging portfolio companies where there's additional equity value within those businesses or profits have grown very, very strongly. We have just take up leverage up to where it was before or where we would think is a prudent level to take it. And it allows us to take cash out of those strongly performing portfolio companies and reinvest those proceeds into new investments. I guess the important thing to highlight with new investments is, as Paul mentioned, they're immature situations. We're investing at an earlier stage. We're investing what we think are very, very favourable terms. The market conditions at the moment are positive for us in terms of making new investments. There's relatively little competition at the moment, and so we're seeing a good amount of opportunities to make what we think will be investments that contribute strongly to NAV in 25, 26 and beyond. Just if we go over the page, I'm just going to give you the second most recent investment, which is an investment into Trinitatum. On the next page is an investment in the investment we announced 2 or 3 weeks ago. Trinitatum is a software provider that does test automation into financial trading or energy trading platforms. Just to give you a sense as to the situation when we invested into this business, it was set up just over 10 years ago. It had just 15 employees, and despite that, had nearly 15 million of revenue. We, in this instance, have taken a majority stake, so we own nearly 2/3 of the business. It had 2 founders, individuals named Jed and Steve, and effectively the reason for them bringing the business to market was they realised that they were constrained bandwidth-wise. They were having inbound approaches from prospective customers that they were struggling to kind of respond to or to service in the way that they would want to. And so they realised in order to maximise the potential of the business, they needed additional support. So we felt the business had significant potential. It had the capacity to grow far beyond what it is today. And we effectively brought in a team to work alongside us to be able to do that. So Jeff Hewitt, who joined as CEO of Velocity about 12 months ago. So we've got to know him well. He has joined as non-executive chair. We've also brought in a new CEO and a new finance director who joined at completion. So they've been in their post now for probably about 4 to 6 weeks. And we also have a new CMO joining in June. So in the next, again, 4 to 6 weeks. There's a variety of things that we're seeking to do with that business. There's all sorts of different directions it could be taken to grow. But we think it will be very, very sought after once the management team has done a variety of initiatives that they're focusing on. Huge amount of growth potential, both in the UK and overseas, both within existing customers, to improve commercial terms, to sell more products, and also to expand and diversify the customer base. With Trinitatum and Langford's, it's worth mentioning that the share price at the point that we invested in those businesses was around £4.55 in both cases. So again, just to provide confidence and reliability to bidders, we were able to get both of these deals involving founders who'd never sold a business before pretty swiftly. So again, a successful transaction in both cases. Just pass over to Paul to give a bit more context around people and thinking on Langford's.
So Langford's, which is our most recent announcement, I think is a really interesting case study of the way we kind of think and operate. And so the kind of starting point for this transaction was actually an introduction to a gentleman called Mark Chandler. We were introduced to Mark now nearly 2 years ago. We liked him a lot from our early dealings with him. By way of background, Mark was previously the CEO of a foods business called Meadow Foods, which under his leadership had grown to nearly 500 million of revenues. It had also been through 2 private equity exits, making a lot of money for investors along the way. And so our thought process with Mark was, why don't we try and create another foods group ourselves from a much lower base initially, and looking at the food manufacturing sector. So since that period, we have looked at a myriad of businesses. We've passed on quite a lot. We've actually made offers on a few, and most of those offers were not accepted. I think it's fair to say that the most frequent reason why an offer from Literary Capital is not accepted is we try and avoid overpaying for things. So we tend to be reasonably frugal in our initial offer. We were successful in our offer for Langford's, which is a premium foods business based in Wales. And we are going to, I mean, Langford's is again a kind of a classic example of a Literary Capital kind of deal where we had 2 founders, both north of 60, for differing reasons, essentially wanted to call it a day. We have a younger guy called Josh, who's in the business in his 30s, who is young and ambitious, but probably needs some mentoring. And I think that will be Mark's role. But we want to use this as a base for growing and building Langford's. And there are some reasonably obvious things that I think we can do quite quickly to professionalize and grow and develop the business. But then on the back of that, go out and do further M&A in the premium meats business with a view of building a large group. And so if you look at our methodology here for creating value, one is to try and buy well, where we're buying on hopefully reasonably attractive multiples. Secondly, create some organic growth from each of those businesses. Thirdly, undertake some accretive M&A. Fourthly, professionalize the business to a point that there will be a lot of interested parties in acquiring the business when it's got some scale. And then fifthly, exit at what will be a much higher multiple than those multiples that we entered into it in the first place. So I think Langford's is a very good case study of the kind of way we think and also the value that we think we can bring to the party. The final comment I would make on Langford's is we have invested in this deal really as a partnership with Mark. So Mark has put exactly the same amount of money into this venture as we have done, which I think gives you an indication of his level of commitment and his level of confidence. This kind of slide is included just to give you some more colour. And again, I'm not going to kind of dwell on it in huge detail, but very happy to refer to it if you like in Q&A. But you'll see one of the things that we do have is a reasonably concentrated portfolio. So 68% by value of the portfolio is actually vested in 5 businesses. The comment that you will see here is that of the top 10 investments, we've now been invested in 6 of them for over 5 years. And I'm sure some of the questions will be directed towards realization of investments and creating liquidity. I think what you're now looking at is a portfolio which has got quite a high degree of maturity and has also got quite a high degree of professionalization. across it, and therefore I think you will see a greater degree of exit activity over the next 12 or 18 months than you've seen over the last 12 months. The sharp-eyed of you will note that there's one investment which comprises 31% of the portfolio, which is RCI. We've been involved in RCI now for nearly 7 years. It has been a spectacularly strong performing investment. In that particular instance, we have rebuilt the management team in its entirety. It's chaired by a chap called Chris Sellers, who I've personally known Chris for 20 years and is kind of a very solid and very capable guy. And for the particularly sharp-eyed listeners that we have today, some of you may have spotted that Chris was out in the market yesterday buying 50,000 shares in Literacy Capital, which I think will probably tell its own story, given the fact that Chris's company is 31% of the portfolio. I think it will give you an indication of what he thinks the prospects for RCI and for the portfolio more broadly is. So that was all I was minded to say about the portfolio at the moment, but more than happy to help with any questions. You can see the summary in front of you. I think we've kind of touched on these points in terms of we're looking to build great businesses. Our long-term investment performance since IPO, which was June 21, is exceptional. The portfolio across the piece in Q1 is pretty encouraging. And if I'm frank with you, if we look at some of the headwinds that have been created from a macroeconomic environment, so particularly, for example, the budget and particularly the changes to NI, I think we went into 2025 with probably a degree of nervousness. And you'll have seen from the fact sheet that we released yesterday that we are pretty encouraged by trading, both currently, and I think we're also quite confident about the outlook for Q2 as well. We've talked about the skin in the game that we have. So for those of you on this call that are shareholders, we're completely aligned with you. I think there's a complete continuity of interest, which is not always the case in private equity. And I've also touched on the charitable mission, and we're very proud of the work that Bookmark is doing and the impact it's having. Not too many of you, I imagine, watch breakfast TV on a Saturday morning, but if you were watching BBC Breakfast at 10 to 8 on Saturday, you'll have seen a whole piece with Nagaman Chetty and Charlie Stade, which was dedicated to children's literacy, and you'll have seen a senior person from Bookmark talking very eloquently about what we've done and the work we've done, which I think, again, will hopefully reassure shareholders of the impact that the money that they've kindly helped us donate has had. So that's the end of our summary, and we are more than happy to help with any of the questions.
That's great. Paul, Richard, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated on the top right corner of your screen. But just while the company take a few moments to view the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received questions throughout today's presentation and also pre-submitted. If I could hand back over to you to read through the questions, that'd be great, and I'll pick up from you both at the end.
Okay.
So yes, thank you to those that have submitted questions. If anyone else has any more questions, please do add them into the mix. A quick one to answer. We've got a pre-submitted question around the growth figures, saying, could you provide figures for organic growth? The EBITDA growth figures, I believe, are including inorganic growth too. So the figures that are presented are for the top 10 companies. They do include acquisitions, but if we look at the top 10 companies on this table here, the only business that has completed a bolt-on transaction in the last 12 months, so which could have an impact on those figures, is Halsbury. It's obviously a relatively small part of the top 10 by value, 4.8% at the end of Q1. And the impact of its acquisitions are also not substantial. So in terms of the impact overall on those figures there, the 20% and the 26%, I would estimate it's probably 1% or less of those figures. So yeah, in terms of the organic performance of the businesses we've got, it's very, very close to those published figures that you see there, which hopefully gives some comfort on the underlying performance of those businesses. We have several questions around the the discount of the share price versus above sort of in terms of comparison to reported NAV. So in terms of the discount, I guess there's a variety of things that we would say that would cause that. So firstly, obviously 2024 was our weakest period of NAV performance. So firstly, with a period of improved uplifts, we would hope that that gives people more comfort and confidence that obviously the fund has returned to growth. Q1 performance has obviously done that, and we hope that the next few quarters will continue that. Another factor will obviously be realizations and being able to, well, firstly exit businesses, but also if we can do so on premium to the carrying values, that will also help to provide comfort on the valuations, and again should help to drive an improvement or closer to the share price trading to net asset value. That's obviously something that we're keen to see and keen to do. I guess it's worth saying though that going back to what Paul said before is we don't want to just sell businesses prematurely. We also don't want to sell businesses when the market conditions are particularly difficult or poor, because it does obviously impact the pricing that you're able to achieve. So there is a balance of delivering the exits that are useful and are helpful, but equally you don't want to sell businesses at a time when it's really difficult to, or when pricing is depressed. It was mentioned in the fact sheet that was published yesterday that exits, PE exits that completed in Q1 were the lowest for some time, and I guess it's fairly obvious that given the backdrop of what was kicking off in January, February, March, it was quite difficult to persuade buyers of businesses that now is a great time to be investing 8 or 9 figures of capital into a new opportunity. So as a result of that, there was a slowdown in completions of transactions. These at the point we sell these businesses, they ought to be quite substantial, and it obviously does take some time and some convincing to get people over the line. So it's obviously something that we hope will happen over the course of 2025, particularly if market conditions can be slightly calmer than they were in the slightly chaotic Q1. I guess the other thing we're seeking to do is to build greater awareness. We are a relatively small trust, albeit much larger than we were when we listed in 2021. We're still less well known than we ought to be, and that's part of the reason why we're doing the presentation today, and we've got capital markets events next month, and we will continue engagement with investors over the course of 2025. So there's a variety of things that we're seeking to do regarding driving more demand ultimately, that hopefully will then improve the balance of demand and supply for shares of Literacy Capital. As Paul's touched on, we think there's a variety of reasons as to why the NAV performance of Literacy Capital should outperform other trusts, focusing on smaller companies where pricing is lower, where we still have the opportunities to grow and develop the businesses and build the management teams and improve the businesses and teams so that they will become attractive targets for more established players. And we've kind of demonstrated in 2023 multiple times that we've been able to do that. We've been able to sell to very blue chip established investors. In some cases, we've also rolled proceeds from the sales and reinvested alongside those investors. All of those things I would expect us to look at doing in 2025.
Just to pick off one or two of the other sort of shorter questions. So we've got one from Richard F. Regarding discounts and valuations and exit premia. So I guess I'd make a couple of comments here. One is, if you look at the history of Literacy Capital, there is no investment that we have ever exited that has been exited below NAV, which I think provides some comfort regarding our valuations. And secondly, in many instances, those exits have been at a premium to NAV. The second comment that I was going to make around our valuations is, again, for the sharp-eyed of you on the slide 11, you'll have seen across the portfolio that the portfolio is valued on an average EBITDA multiple of 9 times. And again, if I was to compare and contrast that with the private equity sector as a whole, if you look at the listed private equity sector, their average valuations are somewhere between 14 times and 25 times. So if you were to produce a graph of the respective valuations of the portfolio, we would be sitting very far over on the left-hand side. And so I say that simply from the perspective of, from our point of view, there's no financial motivation to us in overvaluing something. It's a pointless thing to do. And actually, we are probably the most cautious of all of the private equity houses in terms of our valuations.
And if we ever had any doubt in terms of the carrying valuations being realisable or achievable, then obviously we would reduce the carrying values in line with what we think those what these businesses would realise as and when they were sold. So in terms of whether or not the businesses will be sold in line for carrying value or materially more, it's obviously impossible to say until they are sold. But obviously we want to realise and sell the businesses for the best price that we can. And in order to do that, inevitably it requires some patience to be able to do so.
I think there was another question which was how we actually go around the exit process. I think it came from Neda. I think the first thing I would say is almost invariably, if we're looking at exit, we will select a suitable financial advisor to work alongside us. So there are a number of pretty respected financial advisors out in the market that help with the sale of businesses. You won't be surprised to hear that a lot of them invest a lot of time talking to us because they're trying to sell their services to us. But equally, from our perspective, we want to choose an advisor that we think has got specific expertise within the sector that we're working in. We will then work with that advisor in terms of how we will present our company in the most attractive way, which invariably means writing an information memorandum and then also having a target list of buyers. And so again, this is a slight generalization. We may start off with an initial target list of 50 plus, and then end up hopefully with 4 to 6 genuinely interested parties. But the exit process we try to run in a pretty disciplined way. And actually, if there's any hypocrisy about what we do at all, it's an interesting compare and contrast, because we try and buy into situations, generally speaking, where there isn't huge advisor input and where there's not a competitive auction, because we want to have a one-on-one conversation with the founder and see if we can win them over on a whole range of points, which are not always financial. But turning it full circle, if we're exiting, we wanted it to be a pretty disciplined process, and the financial element of it is clearly pretty important to us.
We've got a question from another Richard saying, how are we finding conversations with banks when refinancing? Whilst convincing bidders to part with significant sums of money has been quite difficult, and that kind of the data backs that up, I would say conversations with banks and appetite from banks and lenders has actually remained very, very strong. And kind of inherent in the jobs that we do, we end up speaking a lot of time to lenders. And I would say the pressure that they are feeling is around deploying capital. They have targets around getting money out of the door, deploying it into new opportunities or existing portfolio companies that they already lend to. And it's quite difficult for them to reach those objectives and targets when new deals are not completing. And so they are trying to be as helpful as they can be, and hence why conversations regarding refinancings have been quite straightforward. So yeah, banks, unlike 2009, definitely open for business, more than amenable to refinancing conversations. And yeah, I'd say market conditions on the lending side look very good. I've got another question around, and it's one we've been asked before actually, as to whether we would take a stake in public companies, as they are relatively inexpensive at the moment. It's a good question. The honest answer is we haven't really given it much thought, and the answer for that is, I guess, several-fold. When looking at a public company, we get far less information and far less access than we have when making an investment in a private company. We get full access to information, company, people. We get a huge amount of information, and also we get a huge amount of protection in terms of the legal documentation that is put in place. We get no protection and no information advantages versus anybody else when investing in a public company. So again, that asymmetric availability of information and also legal protection is not available to us. We also would have no real access or discussion with, say, the founders or the owners or the management compared to what we do have with private companies. There's also no structuring benefit, in terms of the investments that we make in these smaller private companies. We do get the benefit of being able to raise senior debt to help fund part of our investment. We do also get other structuring benefits in terms of, different classes of share and all sorts of different things. So you look at investments that we've made, Trinitatum, that's a business that is making several £1 million of profit, and we've taken a majority stake for less than £3.6 million. That would not be possible, regardless of how cheap public companies became, to get anything close to a deal that was as asymmetric as that. So again, it's not something we've ever really given more than a second's thought to, I would say. And there's a whole plethora of reasons for that. That means that, if we're able to help the businesses to the extent we think we can, we've now got multiple businesses. Our top 3 holdings there that you can see, we've made 20 times our money, 10 times our money, and about 35 times our money. That would be very hard to do investing in public markets. So that's kind of the reason we've stuck to focusing on buyouts of private businesses.
The question that we've had again from another Richard regarding the portfolio being broadly spread and therefore kind of the opportunity it gives us to get information about the state of the UK economy. It's probably worth saying from a reporting perspective, we have good processes within Literacy Capital, and therefore we get detailed reports from each of our 21 portfolio companies, at least on a monthly basis, and actually on some of them on a more frequent basis, particularly if they've got a consumer bias. Of the 21 companies today, I would only say that 2 of them are materially consumer facing, and I'll come back to those in a minute. I guess the general comment that I would make is we are surprised and pleased with how resiliently they are trading, because again, as the question kind of alludes to, there's been quite a few headwinds that have been put in front of UK smaller companies in the last 6 months. So the budget process was not handled well because it created a lot of uncertainty. The changes to employer NI were pretty horrific for a lot of companies. Again, not particularly well judged from our perspective. And so, as I said in my kind of piece earlier, I think we were slightly nervous in January, February as to what the year was going to look like. We have been really pleased with the way that businesses have come through it. They always seem to find a way of making sure that they can come through as positively as possible. We have 2 businesses where they are consumer facing. So one is Oxygen and the other one is Holsbury. Holsbury provides educational trips for children on behalf of schools. So the schools are our customers, but we're organising trips to go for children around different parts of the world. That business is trading superbly. We're quite surprised and pleased, but is comfortably ahead of where it was last year. And we also have a business called Oxygen, which is children's activities. And again, the business is trading pretty resiliently. And again, probably ahead of our expectations. So I think it's a really good question because there obviously has been a degree of uncertainty. But at the moment, the companies that are in our worry zone is a pretty low number.
I'd also add, in a small business, the calibre of the management and the decisions they make can have a significant impact on performance, which again is why we spend as much time as we do to make sure that the management teams we've got are as strong and as complete as can be. So I mean, if you look at, you look at some of the portfolio companies, we've been relatively interventionist when needed. Velocity has gone through some significant change in the early part of 2024, and those changes I mean, the business has come on leaps and bounds to the extent that it's been our strongest performer in the last 3 quarters. So again, if we're able to have the capacity and ability and power to make those changes, and then we get those changes right, the ability for management to, I guess, sail through times that might be tougher from a macro perspective, they should still have the ability to find ways to allow their businesses to thrive. There was an earlier question around when we think about, or how we think about selling businesses, and if there are criteria that we think about. We wouldn't say we have fixed criteria. I guess when we think about selling a business, it's always done in discussion and collaboration with the management teams of those businesses. And so it's, you know, trying to work out when is the right time from a management perspective, you know, as and when we think is the right time for being able to get the price that we would want. It's a combination of factors. We're pretty open to taking on board the wishes and preferences of management. You know, they're the ones that are doing the work, and they're the ones that are closest to their business. So if they've got strong views, then ordinarily it's probably worth taking those on board. We've got a question from David around RCI and its exposure to local and central government. I would say, and it's a question I've probably was asked yesterday, not all government spending is the same. You know, if you look at certain departments that are taking, I guess, the biggest cuts or have the biggest pinch points, those are not the areas of government that RCI is working with. I guess there's always a perception that the NHS is sort of under pressure. I guess that is true, obviously, to an extent, but the reality is it is always a priority of the government, whichever government is in power, you know, to make sure that it has the cash and it's able to provide the services that it needs to. So in terms of its exposure, I would say we're reasonably sanguine. Obviously, the state of public finances, you know, there are some obvious challenges, but we're not really seeing that impacting RCI in a meaningful way. And as Paul alluded to, I mean, the chair of RCI, who is also a non-exec director of Literacy Capital, bought 50,000 shares yesterday, which I guess provides some comfort on what he thinks of trading at his company and the portfolio as a whole. But yeah, it's a fair question to ask, but it's not something that bothers us hugely.
There was a question that was also posted in terms of how do we source deals. The answer to that is through a whole myriad of different routes. So the most obvious route is we have an advisor network of predominantly small corporate finance advisors. They're often 1, 2, 3 person boutiques. They know what we do and they like dealing with us. And so we will probably see a new opportunity 2 or 3, 4 opportunities a week. We get a very, very high volume of kind of inflow. The reason advisors like to show us things are, one is they know that we tend to be very swift. So they value a swift no as much as a yes, because it means we don't mess them around. They know that once we say we'll do something, we don't chip, which again, the private equity industry doesn't have a great reputation on that front. They'll agree a deal and then towards the back end of the deal, they'll try and change the terms. We never do that because we think it's a morally poor way to behave. And we also make sure that the advisors get paid properly. And so if you treat the advisors respectably, we kind of get our returns and the fact that we get shown an awful lot of stuff. And then there are other routes through, if you like, people we know, contacts that we have outside of the advisory network.
Question around, if realizations are made, what would be done with that cash? So I guess, as I mentioned before, there's been a push to do some refinancings and we expect to continue that. I guess the rationale for that is it's been as I've discussed and also sort of widely sort of commented on, it's not been easy to complete sales. And so we have the complete power to refinance the businesses as and when we would like to. So it's making sure that we've got a steady flow of cash coming in and not having to rely on anyone else in order to receive that. We would expect and we would like there to be some significant cash inflows from sales. But as I've said, we're not able to control wholly the timing of that. And it's quite a binary yes or no, it either happens or it doesn't. So those cash flows can be slightly unpredictable and obviously quite significant and quite lumpy. We did set up about a year ago a B share scheme, which gives us the ability to return cash to shareholders in a tax efficient way, or a more tax efficient way than paying out dividends. And so if we do get a significant cash realization, we have the capacity to use that scheme to return cash to shareholders. It obviously remains our intention to be able to do that. And if we do get more cash than we would expect to reinvest in the short term, we would like to be able to use that scheme. We are all, Paul and I are aligned with other shareholders and would kind of receive a pro rata of those shares of that cash. So yeah, it's a balance really of how much cash arrives, when it arrives, other opportunities we might have for that cash, albeit at the moment, in the last 12 months, we have completed 5 new investments, which for us is a reasonably large number. We do feel the portfolio at the moment is in good shape. And if we give the existing portfolio some love and time and effort, that there's quite a lot more in terms of uplifts that we can achieve from it. So it's a slightly long-winded way of answering the question, but just trying to give a bit of insight as to how we might think about it. But yeah, it will be a mixture, I would assume, of redeploying that capital to an extent where needed, where the companies need some support, but also seeking to return it in some capacity, whether it's the B share scheme, whether it's potentially buybacks if we think that's a worthwhile thing to do. But again, if we can start to generate some uplifts in NAV and also some realizations, we would hope all of those initiatives would help to address the currently wider than normal discount.
Just conscious that I only answered half the question that was asked earlier regarding how we source deals, because the other half of the question was how do we choose which ones we want to do, which is a very good question. You'll see from the breadth of the portfolio that we're reasonably sector agnostic. What we are looking for are what we believe are fundamentally good businesses. So there's no pleasure in going into something which on day one is going to be a battle or is going to need a major turnaround. So we want something which is fundamentally okay. We want to be in a position where we believe we can buy it at an attractive price. I mean, if you look at one of the best ways of creating value on any acquisition, it's buy it at a low price. It's as simple as that. We also then want to believe that we've got an angle where we can add significant value to the business. And so we can do things in a way which are more professional or will make the business more successful. And there are a lot of examples that we could give. So it's quite interesting, for example, the number of businesses we counter where they don't really have a proper finance function, and a good quality finance function will inevitably generate profit. It's interesting how many businesses don't have a proper sales function. We've even invested in businesses where they barely employ a salesperson, which makes it very hard to create organic growth. And therefore, if we can rebuild a sales function, that will create success. There's often a lack of thought that goes into pricing. And so you get companies that are selling services for well below the value of those services. And so we look at whether there's a pricing opportunity. And so we look a lot at what are the things that we can do to help make this a more successful business. Are there people that we know in our network that we believe can make the business more valuable? And then ultimately, do we think we can mold this into a business that if we were to run an exit process, there will be an interesting group of people that will be wanting to bid for it? So those are the kind of thought processes we go through. We avoid those things which are, one, countercultural with our charitable objectives. So we don't do alcohol, we don't do betting, we don't do debt collection. There's a few things that we won't touch because we just don't like them. And we also try and avoid businesses which are very capital intensive. We prefer businesses where profit turns into cash reasonably swiftly, because they tend to be of a healthier nature for what we're trying to do. I think if we look across all the questions, I think we've addressed all of the questions. For those people who've also put very nice comments about our charitable endeavours, thank you very much indeed, we appreciate it. If there are no other questions, Alessandro, I think we're minded to hand back to you, and simply to say to everybody, you'll have gathered from the presentation today that we are in a confident mood about 2025. We've already made a couple of good investments, and we're hoping that as the quarters evolve during 2025, you'll see more good news coming through in terms of NAV uplifts and also the prospects for our business.
Perfect. Well, Paul, Richard, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team, we'd like to thank you for attending today's presentation, and good morning to you all.